Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through some Jesse Livermore cylinder patterns so you guys can kind of see what they look like and where it's occurred in other sectors. So we can take a look at, say, I've got Apple in the background here. We're going to look at Amazon. And then we're going to look at maybe a couple of companies that possess this Livermore cylinder. Now, the cylinder, it's an accumulation zone. It's an accumulation cylinder. People are accumulating it, and it creates this pattern as the herd accumulates a stock or certain stocks in certain sectors and whatnot. And I think it's a very important pattern to look for as people are accumulating. And I'll kind of tell you where these things somewhat happen. So usually you get like a double bottom and then they start an accumulation cylinder. Sometimes they happen in the bottom of the double bottom as well. You can kind of see them all over the place. And I'm going to use a couple of tech companies as examples and show you kind of how the cylinder played out so you can kind of see what's going on and maybe what to expect of what's coming ahead of us. I'm seeing these accumulation cylinders all over the place in commodity companies. It could be energy service, it could be uranium, it could be the exploration production in oil and natural gas. They're all over the place. And when you identify them, I think the most value is it's not the pattern itself, although the pattern itself is important. You want to know why they're, the why behind it. And when I looked at, I've been in manufacturing for a long time, and what you want to do is basically, if you perform a process, you want to check it's good right after. And that's really what we want to do. We want to look at the patterns, check to see if they're good, but you want to understand why they're forming, because then you can go forward, like backwards, and look at the leading things of why things are happening. Those would be your leading indicators. The charts and the patterns that are created, all they are humans interacting with each other, given certain market conditions, creating these patterns. So what you want to do is you want to look to see what market conditions are creating these patterns and why. I don't think that it's solely based off of supply and demand. I think it's deeper than that, because I find it very hard to believe that we are having all these commodities all at the same time exhibit these patterns. It makes me think that the market conditions, it's financially driven instead of driven from the bottom up. It's from the top down, in my opinion. And what happens is you get this liquidity or credit come into the system. It wants to buy things, but it puts everything into a shortage. That is AKA inflation. And that's where it basically stresses the system and money starts to rotate differently. That's really what it is. And interest rates are the driver. So inflation comes into the system, drags those interest rates up, money starts to rotate and prefer different assets than what they had before. Before being a low inflation, low interest rate environment, it's completely different than a high inflation in an increasing interest rate environment, or even a high interest rate environment. Depends on how that looks. But let's look at the pattern. Let's focus on this for now, just so you guys kind of know what it looks like. So again, this is just my financial opinion. You can do whatever you want with it. It's really just learning patterns and herd mentality behavior. So I've got Apple in here, and I've got the Livermore Accumulation. This is the accumulation cylinder with widening mouth. There's 7 points in this accumulation cylinder. It's 1, 2, 3, 4, 5, 6, 7, and it's an increasing cylinder just like this. That's increasing. Apple's got what I would consider to be the accumulation cylinder. It's 1, 2, 3, 4, 5, 6, 7. Now, these cylinders can look kind of scrunched up. They can be distorted. It doesn't mean that number 5 has to be on this line. Number 5 could be up here, and it would still be valid as long as the pattern exists in roughly this type of condition. So it's 1, 2, 3, 4, If 5's up here, that's okay, or if 5's down here, it's okay. It doesn't have to be on this line. It could break down. 6 and then 7, you usually get these double humps here, and then you get this like dead period, and then you get the launch. And then the launch, obviously this one broke out quite tremendously for Apple. And I'll kind of just show you what this looks like. Point number 8 would be this guy here. And then you get this mid wiggle a lot of the times. Point number 9 would be here. And then number 10 is the top. And then you get this, that other one here. Point number 11 and 12. And these can be, so let me back out here. Point number 11. So you get a double top, point number 11 and 12, and then you get the pullback. But this rolled right into another accumulation cylinder, which is pretty crazy, in fact. So this rolled into another accumulation cylinder, 1, 2, 3, 4, 5, 6, 7, and then you get the break. And then we went into a massive, what could be, a shoulder, head, shoulder, and then the break down. And it looks like it's starting to ramp back up for Apple. But I don't think this will be long. I don't think it's going to create new highs. I think it will roll over eventually, given the market conditions. But that's Apple, and they had 2 accumulation cylinders in Apple if you kind of back out and look at this big beast of a move. So there's that first accumulation cylinder, the second one here, and then the break higher. And this is flat to slightly more inclined to vertical. Amazon also possesses this. So let's take a look at this. And what I did, I didn't do the accumulation cylinder. I did a bottoming pattern on this one. What this one has is a bottoming pattern there. And then you can see that it based out. Let's zoom in here, guys. And what's important is to identify these things, all right? It's important to identify what's going on here. So basically, you can kind of put this here. And what do we see here? This is an inverted shoulder, head, shoulder. That is a bottoming pattern that we came back down into. Now, a lot of things that I see on YouTube is I see these inverted head and shoulders, and people are putting them as continuation patterns. I don't think that's the right use of it. Generally, they're used as bottoming patterns and topping patterns for a head and shoulders pattern. This one's just inverted. And usually what you get is you get a breakout, and you can get sometimes a little bit of a retest and then a move higher. The important thing here, and I know that it's easy to be viewing this, and we know what Amazon is to hold on. And you come on up, you hit your head on some resistance here, and we didn't know that resistance was there. Let me kind of delete that out. We come on up, and we went sideways for a little bit, but there's no reversal pattern here. So what it did is it consolidated and created another consolidation area. And if we kind of draw this in, you can see that it's a kind of a megaphone type pattern and finally broke to the upside there. It even did a back test later on in 2008 and 9 at back test, even though it broke out in 2007. And the person who held on would have really benefited from that, because this had a massive run afterwards. So really what I want to say here is we had a massive run higher. We had the market conditions change, and this was the 2000 kind of crash, 2000, 2001. It bottomed in 2001 for Amazon here. And we're looking for those bottoming patterns. The key here is to be patient after they occur. So what happened is we had a little bit of a consolidation right above the inverted head and shoulders. We came up and consolidated again, and then just blew off to the upside in a massive uptrend fashion. Obviously, it's driven by a couple of different things. It is driven by the fundamentals of the company. It's also driven by the market conditions that this traded in. The reason it didn't go up a ton in this general vicinity here is because the market conditions were not conducive for Amazon to go up. The money did not come and rotate at it. It did go up. It went from $1 all the way up to $3 and then came back to $1.34. But the market conditions were not favorable for Amazon. Once those market conditions became favorable and it broke out in the year 2009, it was game on, see ya, wouldn't want to be ya later, and just absolutely smoked it all the way up to $178. So the person who was early and bought it in here, you'd have to be really patient because the market conditions were not ripe for that. The way that I would view this is the market conditions became ripe in 2009. So this would have been your buying point in this general vicinity here. That would have been the perfect entry point at about $2 to $3 all through this range, all up here, and the breakout at $5. And then you would have held all the way up to about $200 almost. So that is what we're starting to see in commodities. What people get worried about, let me zoom in here. What they get worried about is, let's say they see the inverted head and shoulders pattern. They buy it here, which is still an amazing entry point. And it comes on back and it goes from $1.25 down to 95 cents. They're going to be down 30%, roughly speaking, a little less than 30%. They're going to be, man, I'm down 30%. What's the right thing to do here? You want to buy a bunch more. You cost average in this entire general vicinity here, that entire vicinity where we're basically consolidating there. You see that pattern? Let me zoom in on it a little bit. And the reason it's so important to understand this is we are forming these patterns in commodities. So there's your pattern there. It's kind of like it's squeezing up, and then we break, and then we just hold on. You hold on for dear life. Now, remember, Amazon did this bottom and broke to the upside in an unfavorable environment. So it didn't get that big run and continue. It ran and consolidated more because it was in an unfavorable environment with increasing interest rates from 2003 all the way to the break of 2007. So it's consolidated for 4 years. That would have felt like torture, even though this was one of the strongest companies in the world. So we look at, say, Camco. And remember, we had an inverted head and shoulders, all that stuff. Camco also had a massive pattern that was bottoming, right? And I can draw something here. We've got that accumulation cylinder that I have drawn in. So there it is. It's 1, 2, 3, 4, 5, 6, and then 7 blew out to the downside. And it's a little bit weird looking because it has the double humps coming on up. And it's not as clean, but this is an accumulation cylinder that lasted from 2000. In 2002, it dropped down from $5 to $2.80. It was a big move lower. And what's important is to know the market conditions. The market conditions in 2002 were ripe for a commodity bull market. And keep in mind that uranium was in a surplus during this time frame. It was in a surplus. And what we want to do is we want to identify companies that are sitting here and are ready to go on up. And what happened after that? The big old move. This guy moved and moved and moved. Now we get these little wiggles here. Those usually happen mid-run. You get a consolidation, then you get the last push there, and that would have been the top right there. So when you look at this, basically you come on up, you get a little bit of a consolidation, you have another wiggle coming up, a couple of wiggles. You get a long consolidation period sideways, and then one last push, and then you go into a longer consolidation period. And we went into this massive consolidation period, and then we start all over again. And you get this kind of last, it's a 1, 2, 3 hump consolidation. We are seeing these consolidations on oil and natural gas right now, this 1 hump, 2 hump, 3 hump, and then we usually start over and and do another big pull after that. A lot of the companies are putting in these 1, 2, 3 hump consolidations right now and are right at the ends of them. Looking at Camco, we've also gone through this cycle. And here we are, and this is what it looks like now. We've ended the consolidation number 3. It ended right here in a false breakout. We did a 1, 2, 3, 4, 5, and then 6, 7. It's kind of messy. I get it. And now we're starting to break to the upside for Camco. Just like Apple, just like Amazon, and some of these other ones that put in bottoming patterns, consolidation patterns, which are these guys here, and are starting to accumulate in this accumulation cylinder. So I think this looks really good. And this isn't the only company that possesses this. There's a bunch of different companies that have these accumulation cylinders all throughout the sector. You can find them all over the place. You can also find them in a bunch of different commodities. You can also find them in something like crude oil. And if you kind of look at crude oil here, and if I were to just kind of throw, something in here like this, we can see that we kind of have something going on here. 1, 2, 3, 4, 5, 6, 7, perhaps, and then we'll break and run higher. Sometimes on these, you get these wedges that form, which is a consolidation formation, a falling wedge, and then we break it to the upside and run. It doesn't mean that we run immediately. We could very well do a couple of little humps here or something like that. I don't claim to know the path. I'm not here saying that I'm some sort of genie in a bottle that can predict the future, but it's got an interesting pattern. That's all I'm going to say. And it very well could be an accumulation cylinder where we had much, much higher. And if we look at the previous bull market in it, I don't think we saw any cylinders there or anything like that. Let me see here. But we did have this lead-in pattern. Looks like that, and that kind of looks like this guy here. That pattern and that pattern are roughly the same. I'm sure this guy is probably somewhere like that, and there was a pattern that looked like that even before that, which is one big consolidation pattern. And then we break out. You get a pullback here. That's that first pullback. That is, so here is here somewhere. And then we head on up. That is my guess. So that's kind of the accumulation cylinder. That's kind of what I'm seeing in patterns for some of these commodities and companies. They're out there. But, I'll just say a couple of things real quick. You can get the right sectors. You can do all the work. You can know where to be. There's a couple things, if you want to make a lot of money, that you have to kind of do. You have to know where the value is, and that's what the ratios are. It's part of the thesis of the channel. You want to know what are good ratios, what's turning around and looks good, what's being accumulated, what's putting in bottoming patterns. And then the next portion, because that gets you the sectors, then you have to understand what companies are going to give you that max leverage. Where is the best risk reward and probability of success? That's what comes next. And certain sectors have better probabilities than other sectors, in my opinion. And other sectors also have more upside oomph. So the best areas to play would be the ones with the best risk reward with the highest probability. That is how you make a lot of money. You have to identify the best sectors, highest probability, and the companies that can give the best bang for the buck. And what I'll say there is this all fits together to become a very good investor. It's not just one aspect. When I just did technical analysis, I didn't understand anything. You're basically looking at patterns blindly. you don't know why the people are accumulating it behind the pattern. If you know the why, that is where you can really leverage your knowledge and dump money in at the right time. Because you know the market conditions are changing where that money's going to rotate into it. But what I was going to say is you want to find companies that can cash flow, that have existing infrastructure in place. There's your probability. That's just way out of favor. So you're just playing one big, large, leveraged bet on the sector coming back into favor. And then you want to look at, what does five years from now look like? And when you think of it, think of oil and the potential shortages of oil, or the tightness in oil. And we've been underinvesting. And just think of this for a little bit, guys. It's not that hard. We're underinvesting and oil is going to get really tight. So that means oil prices are probably going to go rocketing higher. How do you solve that? It's not that hard, right? You're going to invest a lot more money. All right, so if they're underinvested and we're going to go tight in oil and oil is going to become very expensive, and at some point, if we want to produce more oil, we are going to invest copious amounts of money. Who do you think will be the benefactor of investing copious amounts in oil and in drilling for more oil? The energy service companies. And if they're going to be drilling a lot more, and the quality and grades of the fields are declining, it means they have to drill at even faster paces, put more holes in the ground, become more efficient, etc., etc., etc. They're going to spend more money for less oil in the future. The people who are going to make a lot of money are the energy service companies. That's one example. So you want, in my opinion, that could be one sector to look at that is cheap, and we look for particular patterns. If you guys need any help with this stuff, definitely check out the channel, Finding-Value website. It's discount for the coupon code if you guys want to become a platinum member. I am helping people identify great-looking companies, and I'm positioning myself, and you can see how I'm positioning in it. I can't give advice. I can't do any one-on-ones or anything, but you can see what I'm doing, and you can make your own decisions on how you want to do that. But it's very important to structure the portfolio in a way that you capture some of these gigantic gains in the least amount of risk. That's what I'll say. So you might want to learn on how to structure a portfolio with position sizing, looking at some of these bets, and how to measure that risk, I should say, that risk reward. So I just wanted to kind of talk about that. So it's the Jesse Livermore cylinder pattern, sizing these things up, getting the right sectors right, and then really leveraging that knowledge to get the best risk reward with the highest probability of success. That's how I've really made the most amount of money. I overweighted the right sectors at the right time. That's really what it is. There are more speculative sectors like uranium and some of these other ones that don't make a lot of money. There's a lot of risk there. How are they going to raise money to become a developer? They're probably going to dilute some shares. I do think it's a really big upside potential reward in that area. They do possess very good looking charts. You just carry a little bit more risk. So I don't put as much allocation to it, perhaps, myself. And I try to allocate to maybe other sectors that have infrastructure in place that can easily generate cash flow in very short periods of time. All it needs is the sector to turn around. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.